Subscribe to our YouTube channel and press the bell icon to get the latest updates.
GDP growth in India was expected to be around 11 to 12% this year. However, after the second wave, a lot of data is emerging that is showing that growth may actually not be as much as that. It is not that it will be worse than last year. It is not that the economy will contract further. No. It is that the economy will not grow as fast as most people expected it to. Now, we're looking at data about things like the Purchasing Managers Index, vehicle sales, employment numbers, Manrega numbers, and most of these show that there is either job loss or that things are not improving at the rate one would have expected them to improve and hope that they would improve. The forecasters like JP Morgan has cut the growth number for India for this year from 13% to 11%. Moody's has reduced it from 13.7% to 9.3%, which most of this means that the economy will not be able to go back to pre-pandemic levels. It is not that compared to last year, quarter one or the April to June quarter, when things shut down because of the national lockdown, it is not that compared to that things will be worse, but that it will grow much more slowly. So what are these indicators? In my column with my co-author Radhika Pandey, I've discussed these indicators, and the link for the column will be given below. Let's just go through a number of those things that are telling us that things will be more difficult or less difficult, and how we can understand from them the direction in which the economy is going to go. Now, we first look at the Purchasing Managers Index. Now, here, things are not so bad. In fact, this has improved because of global factors. The world economies, particularly the US, is picking up, and therefore the exports are doing better in the Purchasing Managers Index. So that's one data point where, though domestic demand is lower, export demand is not so bad, and so the indicator is not showing as much of a decline as one might have worried if one thought that this was mainly due to domestic factors only. The second data series we look at are job losses. Now, in the month of April, in rural India, there have been 7.35 million job losses. And what is new is that, in contrast to last year, it is rural India which is also losing jobs, and therefore that could impact demand if that continues. So about 2.14 million people in rural India who were salaried employees. Now, whether they were salaried employees because they worked in schools or shops or other facilities, but they have lost their jobs. Again, another way of looking at job numbers are Manrega numbers. So, has the demand for jobs increased? Now, you compare this to April last year. In April last year, there was a lockdown. In fact, migrants had not gone home. So, in some ways, the Manrega numbers were the normal sort of Manrega numbers in 2020, April. And they were 1.2 crores. 1.2 crore households were asking for jobs under Manrega in April 2020. This time, that number is 2.2 crores. So, roughly double the number of people, number of households are demanding jobs under Manrega. Now, this is partly due to job losses in urban areas and reverse migration that happens to rural areas, and partly due to subdued activity even in rural areas, because as we saw, rural salaried employees have also lost their jobs. Again, a third indicator is vehicle sales. which the April number shows is down by 30%. But then all may not be that gloomy, because the GST numbers that we see were high in March. We have to wait to see April numbers. They look a bit subdued from the e-way bills data that is there. But that's something that we will wait to see and find out how that goes. Now, consumer sentiment, as you can expect, is down by 3.8%. Inflation has actually not risen in the month of April. The inflation number has gone down to 4.29, primarily because inflation had spiked last year. So there is what we call the base effect. That is that the base went up. And so when you compare year on year and compare it to the last base, it is actually, it appears to be lower. And that is something we'll have to wait and see. Now, on inflation, just an update that while on the one hand there might be imported inflation, and this is something we've talked about in an earlier episode, that there might be imported inflation either due to global commodity prices rising because the US is seeing high growth, or maybe if the rupee depreciates because of capital outflows, and that might both put together give us imported inflation. But on the other hand, local demand conditions may not be that good. And because there are suppressed wages, there are suppressed incomes, local demand conditions may lead to actually lower prices, and therefore we may not get inflation effects after the current supply disruptions that we'll see due to the lockdown are eased out. So overall, the picture is that growth will be positive. Unlike last year when it was a contraction over the previous year. No, so this will be an expansion over the previous year. It is not a nationwide lockdown. There are many activities that are continuing. What is worrying are, of course, the number of cases and the spread of the disease to many areas where it had earlier not gone. But it is not a one-stop inactivity of the kind we saw last time. So last time was a supply-driven phenomena. This time, to some extent, it is supply-driven because of local lockdowns, and to some extent, it is demand-driven because people are doing more precautionary savings, not willing to spend. Investment, which can be up to 30% of GDP, is something that could suffer, particularly private investment, because this is not a time when people will invest. So consumption demand being suppressed, private investment being suppressed may lead to an expansion that is far more muted than we thought we would see. And that's the reason why you've already seen forecasters reduce their expectations about forecasts, about the growth numbers, and you'll see them come down a little. See the others also come down. When you've got RBI and IMF and the government, and most forecasters are expected to actually revise their forecasts downwards. And I think the only way out, of course, is the vaccine and how fast we vaccinate people, and the second wave doesn't happen to the extent that it creates so much havoc that we don't see even these levels of, say, 9 to 10% or some call it 8.5% of economic growth that we are likely to see this year. I'll take questions on this and much more on Tuesdays at 4 at the Print's column. So please do send your questions in, and hope to see you then. Thank you.